Most people enter the stock market with a specific understanding of what it is: a place where companies raise capital, a place where investors buy ownership stakes, a mechanism that prices assets based on the collective judgment of all participants. That understanding is partially correct, and the part that's missing is where most retail investors lose most of what they lose. Because the market isn't a neutral mechanism. It's a system, with structure, with participants who operate inside that structure very differently from each other, with advantages that are built in and distributed unequally. The first structural reality is that price discovery is asymmetric. In a genuinely neutral market, all participants would have access to the same information at the same time. Price would reflect the aggregate of equally informed decisions. That's not how markets work. Information flows to large participants first: institutional research, earnings guidance in private conversations with analysts, alternative data, satellite imagery of parking lots, credit card transaction data, shipping container counts, that quantifies what's happening inside companies before it appears in public filings. By the time information reaches the retail investor, through a news article, through a social media post, through a financial media segment, it has already been acted on by participants who had it earlier. The retail investor is not buying on the same information. They're buying on the residue of information that has already moved the price. The second structural reality is that execution is asymmetric. A retail investor submits an order. It routes through a broker. It executes at market price or at whatever the limit allows. An institutional participant operates differently: algorithmic execution that breaks large orders into pieces to minimize market impact, direct market access that routes orders to specific venues for the best available price, co-location arrangements where the trading infrastructure sits physically adjacent to exchange servers, reducing the time to execute by fractions of a millisecond. That speed advantage isn't trivial. In liquid, fast-moving markets, the price available a millisecond ago is not the price available now. And the participant who executes faster consistently gets better prices on both sides of every trade. Over thousands of transactions, that execution advantage compounds into a meaningful structural edge. The third structural reality is that the incentives of market participants are not aligned with retail investors. The broker makes money on order flow. The market maker makes money on the spread. The financial media makes money on engagement, which is driven by volatility and narrative. The fund manager makes money on fees, which are generated regardless of performance. None of these participants are structurally incentivized to help retail investors make better long-term decisions. The broker benefits when retail investors trade more. The media benefits when retail investors react to news. The fund manager benefits when retail investors delegate their capital management, regardless of what that capital subsequently does. The incentives of the ecosystem around retail investors are almost uniformly misaligned with the financial outcomes of retail investors. None of this means markets are a scam. None of this means retail investors can't generate returns through public markets. It means the market isn't the neutral, equal access mechanism it's commonly described as. It's a system with structural advantages built into specific types of participation. And the retail investor who understands what those structural advantages are, and who therefore understands which forms of participation work against those advantages and which ones don't, operates with a much clearer picture of what they're actually doing when they enter the market. Not a victim of the system, not trying to beat participants who have structural advantages in every relevant dimension. Using the market for what it actually offers to participants in their position, not what the ecosystem around them implies it offers. If this feels familiar, if you've felt this pressure but never had words for it, this channel isn't here to motivate you. It's here to help you see clearly. If that resonates, like the video. Subscribe. More clarity is coming. Institutional money doesn't behave the way retail money behaves. Not because institutional investors are smarter in some abstract sense, because they operate inside a different structural context, with different information, different tools, and different time horizons. And understanding how that context shapes their behavior changes how market movements get interpreted. The information environment is different. Institutional investors have research departments, teams of analysts whose only job is to understand specific sectors, specific companies, specific competitive dynamics. They have access to alternative data that retail investors don't, geolocation data that tracks foot traffic, credit card transaction aggregates that show consumer spending in real time, satellite imagery that counts containers at distribution centers before earnings are reported. They have relationships with company management, through investor days, through analyst briefings, through the kind of access that comes with managing billions of dollars of capital. The information they act on is not the information available in a financial news article. It's more granular, it's more current, and it arrives earlier. The time horizon is different. A retail investor typically thinks about positions in terms of whether they're up or down, whether the thesis is playing out, whether it's time to hold or sell. Institutional investors operate across multiple time horizons simultaneously. Long-term fundamental positions held for years, based on deep analysis of business quality and long-term earnings trajectory. Medium-term tactical allocations, adjusted based on macro conditions, sector rotation, or specific catalysts. Short-term trading activity that captures intraday or multi-day movements, often having nothing to do with fundamental analysis. These different time horizons operate simultaneously, and the activity they generate creates market movements that appear random to retail investors who are watching for fundamental explanations. The capital structure is different. An institutional investor managing a fund has obligations to its investors, performance benchmarks, redemption risk, the possibility that investors pull capital at an inopportune time, regulatory constraints on what can be held and in what concentrations. These constraints shape institutional behavior in ways that have nothing to do with their view of a company's value. A fund that has underperformed its benchmark may be forced to buy winning positions simply to reduce tracking error, not because the analysis supports the purchase. A fund facing redemptions may be forced to sell positions it wants to hold, creating price pressure that a retail investor watching the price move interprets as negative sentiment when it's actually mechanical selling. Most retail investors watch market movements and search for fundamental explanations. The stock dropped. What's the bad news? The stock rallied. What changed? But a significant portion of daily market movement has nothing to do with new information about the underlying business. It's institutional rebalancing. It's index reconstitution. It's fund flows driven by redemptions. It's algorithmic activity responding to price levels and volatility signals, not to earnings or competitive positioning. The retail investor who interprets all price movement as fundamental signal is reading a message that isn't always there, and making decisions based on the narrative they've constructed around movements that were generated by mechanics they weren't aware of. Given everything about how markets are structured, the information asymmetry, the execution advantage, the institutional mechanics that drive price movements retail investors can't anticipate, the logical question is, what should retail investors actually do? Not as a motivational answer, as a structural one, based on what the evidence shows about what works for participants in the retail investor's position. The first structural reality is that most active strategies don't work. Stock picking, selecting individual securities based on research and analysis, requires competing with institutional participants who have more information, better analysis tools, and faster execution. The evidence on retail stock picking over long time horizons is not encouraging. Not because retail investors are unintelligent, because they're competing against structural advantages in every relevant dimension: information, execution, and time. Market timing, moving in and out of markets based on predictions about direction, requires being right twice, on the exit and on the re-entry. The evidence on market timing across all categories of investors, including institutional ones, is equally discouraging. What does work for retail investors specifically is time and low costs. The structural advantage of the retail investor isn't information, isn't execution speed, isn't analytical capability. It's patience and the absence of institutional constraints. A retail investor doesn't face redemption risk. They don't have to manage tracking error against a benchmark. They don't have regulatory limits on concentration. They don't have performance review cycles that create pressure to show returns quarterly. They can hold positions through periods of volatility that would force institutional selling. They can ignore short-term noise that institutional investors are structurally required to respond to. That's a real structural advantage. It just looks like patience, which doesn't feel like an edge. Low-cost index exposure captures the return of the market without trying to beat the participants who have structural advantages, not as a consolation prize, as a structurally sound approach for a participant who is not equipped and structurally cannot be equipped to compete with institutional players on their own terms. The market generates real returns over time. Those returns are accessible through low-cost, broadly diversified exposure, without needing to predict which stocks will outperform, without needing to time entry and exit, without competing with participants who have every structural advantage. That's not giving up. That's correctly identifying the structural position of the retail investor and playing to the actual advantages that position contains. The financial ecosystem around retail investors doesn't frame it this way. The ecosystem benefits when retail investors trade more, when they believe they can beat the market, when they engage with the narrative and react to the volatility and generate the order flow that makes the ecosystem profitable. The structural understanding of what retail investors can and can't do and why is not in the financial ecosystem's interest to promote, but it's in the retail investor's interest to hold. Because the investor who understands the structural reality of markets, who doesn't compete where they can't win, who uses what they actually have, patience, low costs, the absence of institutional constraints, generates better outcomes over time than the investor who tried to play the institutional game without institutional tools. If this shifted something for you, subscribe. Like this if it clarified something.